Welcome to the Deep Dive. We're your shortcut to getting really informed, fast, without getting buried in information. If you like those aha moments and want to grasp things quickly and deeply, well, you're definitely in the right place. Today, we're diving into something in finance that definitely gets people talking. Low risk, high reward investing. I mean, it sounds great, right? Almost too great. Like finding a unicorn. Can you actually limit your risk, your downside, but still aim for big gains in the markets? Which, let's face it, can be pretty wild. Or is it just, clever marketing? So our mission today is to really get into it. We want to unpack the strategies, the discipline needed, and the thinking behind it. We want to give you a solid handle on this really important financial idea.
Yeah, that's a great place to start. It really bumps up against that old saying in finance, no pain, no gain, or higher returns always mean higher risk. And I can tell you, low risk, high reward, it's not just possible. It's actually a key part of how many successful investors operate, if they understand it properly. But let's be super clear right away. This isn't about no risk at all. That doesn't really exist. It's about being smart, about limiting and crucially defining your risk before you even jump in, while setting yourself up for potentially much bigger rewards on the other side. And success, it really comes down to, well, a few key things. Patience, definitely. Deep research, like really digging in. And serious discipline to stick to your plan.
Okay, so it's not about dodging risk completely, but managing it very consciously, controlling it. That clicks. But who does this approach really work best for? I mean, is it more for the quick-moving trader? Or is it better for someone investing for the long haul, looking for solid value over time?
That's what's interesting. The basic ideas, they actually help both. The way they use them is just a bit different.
Yeah.
For traders, it means really zeroing in on trades where the most you could lose is pretty small and you know that number up front. But the potential profit, if you're right, is way bigger than that risk. They call it asymmetry, right? Like risking maybe $1 for a shot at making 5 or more. That kind of setup.
An asymmetrical payoff. Got it.
Exactly. And then for long-term investors, it steers them towards companies that maybe right now the market just doesn't appreciate properly. They look undervalued. But fundamentally, these companies are strong and have real potential to grow down the line. It's about finding those, hidden gems the market's missed.
Okay, that distinction helps. To make it even clearer for everyone listening, could you maybe give us an example, like a typical situation where this low-risk, high-reward thing actually plays out?
Sure, happy to. Let's think about this scenario. Imagine a company, maybe it's been around a while, solid business, good financials, maybe a strong brand or tech, good management, make money consistently. But for some reason, its stock price takes a dive. It's trading way below what the company seems truly worth.
Okay, so why would that happen?
Well, often it's not, because the company itself is suddenly failing. It might be the whole sector is down, or maybe there was some temporary issue, like a factory problem or something not core to the business. Or sometimes it's just rumors, market fear, something external that hits the stock price harder than it probably should.
Ah, okay. Market overreaction, basically.
Exactly. But the key here, the absolutely critical part, is that despite that low stock price, the company's core needs to be strong. You have to verify that. Healthy finances, a history of profit, and importantly, you need to see why it might recover. Like clear reasons for future growth.
Like a new product coming.
Yep.
Or maybe fixing that temporary issue.
Precisely. Or maybe the industry trend is shifting in their favor. So the low risk part comes from the fact that the company's actual value, its fundamental strength, provides a sort of safety net.
Yeah.
There's a limit to how low it should realistically go based on its real worth.
Right, a floor.
Yeah, a floor. And the high reward, well, even a little bit good news, maybe sentiment shifts or the market just wakes up and realizes, hey, this stock is cheap. That can cause the price to jump significantly. So you get a nice profit. You're basically buying $1 for, say, 50 cents and just waiting for everyone else to catch on.
That example really drives home the patience aspect, waiting for the market to catch up to reality, not just jumping on news. But it also sounds like it requires serious discipline. Lots of people get tempted to chase quick profits. What's the core difference between this approach and just, gambling or speculating?
That's the heart of it, really. The common trap, you see it all the time, is people taking huge risks, hoping for a fast buck. Often driven by emotion, maybe fear of missing out.
FOMO, yeah.
And it usually ends badly. This disciplined approach, though, it forces you to pause and really think through every single potential investment or trade. You're not just dreaming about the upside. You have to ask before you put any money down. Realistically, how much could I lose here if I'm wrong? And, just as importantly, how much could I genuinely make if my analysis is right. And there's a key benchmark here for long-term success with this. You generally want to aim for a reward-to-risk ratio of at least 2 to 1, maybe even higher.
2 to 1. So for every dollar you might lose, you should see a clear path to making at least two.
Exactly. Minimum. It forces you to be selective. And it raises a question for you listening. Are you actually doing that? Are you defining your potential loss and gain before you jump in? Or are you just, hoping it works out? That ratio is not just numbers. It's a way to manage your own psychology and protect your capital.
That 2.1 ratio is a really practical takeaway. So for listeners, maybe some are new to investing, others might be experienced traders just looking for a refined approach. What are some concrete tips, actionable things they can do now to start using these low-risk, high-reward ideas?
Okay, yeah, definitely. Let's boil it down to 4 key things and maybe add a little more meat to them than just a checklist first.
Yeah.
Use stop losses, but use them intelligently. It's not just about randomly picking a number. It's your predefined exit if you're wrong. For this strategy, you need to know exactly where that stop loss goes and why. Is it based on a technical level, a certain percentage? Or maybe if the fundamental reason you invested changes.
So it's tied to your initial analysis.
Precisely. It locks in your maximum defined risk on that trade. Protects you. Second, do your own deep dive research. Seriously, getting tips is fine, but you must do your own homework. For LRHR, this means more than just reading the headlines or the last earnings report. Really try to understand the business. What's its edge? Who's running it? What are they paid to do? Look for things the market might be missing or just plain wrong about. You're hunting for that gap between perception and reality. That's where the opportunity lies.
Okay, dig deeper than the surface.
Okay, yeah.
Makes sense.
Third, avoid getting over-leveraged. And this isn't just about borrowing money from your broker. It's also about using things like options or futures really carefully. Yes, leverage can boost profits, but wow, it can magnify losses even more dramatically. That completely undermines the low-risk part of the equation.
Right, it ramps up the danger significantly.
This exactly. The goal here is steady, solid gains from good analysis, not winning the lottery on one risky bet. And fourth, maybe the toughest one, be patient, really patient. Big market shifts, companies turning around, value being recognized. It doesn't happen instantly. These low-risk, high-reward setups often need time to play out. You're waiting for the market to correct itself or for that catalyst you identified to actually happen. And importantly, this patience applies before you invest too. Don't just jump into something mediocre because you feel you have to be invested. Wait for the really good opportunity, the one that meets your criteria, that high-conviction setup. Sometimes the best move is just to wait.
That's incredibly helpful, especially breaking down why those tips matter in this context. I feel like I have a much clearer picture now, and I bet our listeners do too. This low-risk, high-reward idea, it's not some kind of financial magic trick. It's really about, thinking clearly, doing the work, and having the discipline to stick to your plan.
Absolutely. And what's really fascinating, I think, is how these core ideas, defining your risk upfront, doing thorough analysis, being patient, they don't just apply to investing, do they? It kind of raises the bigger question for you to think about. How do you approach other big decisions in life? Where else could this mindset of really looking at the downside before chasing the upside, where else could that help you get better outcomes? Maybe in your career or even personal goals, something to chew on.